Hey, this is BA and welcome to WD Gann's Forex Swing Technique. Through his time and price systems, Gann was able to locate on what day a market would turn and at what price. This is really key to swing trading. The procedure is this: forecast out your highs and lows in time. This is critical. Then, because each pivot, high or low, has an exact mathematical point that it is going to, do the work to determine where that point is for each pivot. Let's have a look. As you can see, this is Gann's 1929 annual stock forecast, and we're using it here because it's one of Gann's actual forecasts. Note that he calls out the time, meaning the date of all the pivots. Posted on my website at the end of December 2015 was the Euro-US dollar for January 2016. December 29 high, January 7 low, January 12 high, January 19 low, January 25 high. Not shown were the price projections for each pivot. Let's add those in. Euro-US dollar, January 2016. December 29 high, 1.0965 conjunct Helio-Saturn. January 7 low, 1.0731 conjunct Moon. January 12th high, 1.0939 square heliocentric Jupiter. January 19 low, 1.0774 opposite Helio-Mercury. January 25th high, 1.0939 square heliocentric Jupiter. Note: study the Great Cotton Campaign in Gann's book, The Tunnel Through the Air, because you're going to want to know, well, where did BA get this? Well, it's from that area. Okay? Very important book there. We can then go to the chart and see how these played out. Actual time and price projection. Okay? And these red diamonds are where the time and price forecast was. Now, what's unique about this is it looks like as time goes on, it gets sloppier and sloppier. This area is just really bad forecasting, and I could go in and explain it to you, but that's really not in line with the goal of this video. Okay? But what's good news for us is we can use this to systemize. Okay? We can use these pivots, this bad area, to systemize, so it's going to work in our favor. In sideways markets, things tend to get sloppy, especially when there's a week or more between pivots and price has little distance to go. In trending markets, the sloppiness goes away. Let's re-examine this and see how price did comparatively. Now, all I'm doing on here is I'm taking the difference between the projected price and the actual pivot where price stopped at. December 29 high, we have a difference of 0.0027. January 7 low, we have a difference of 0.0018. January 12 high, we have a difference of 0.0031. That is the furthest out. January 19 low, we have a difference of 0.0003. January 25 high, we have a difference of 0.0029. Because the highest difference here, and this is a small sampling, is 0.0031, we can say that our lost motion for this instrument is 0.0031. This is important information. So, to systemize our lost motion, what we can do is add a trailing stop once we hit something that's called a price barrier. I'm going to get in and explain these and work with them with you, okay? Procedure's this. Let's say we have a forecasted low at 1.0933. What that means is we've made a price projection forecast at 1.0933, and we are heading down to this point, okay? What we would do is add and subtract 0.0031 to it to get barriers on both sides of it, one high and one low barrier. Okay, so on one side we would have 1.0933 plus our price lost motion of 0.0031 equals 1.0964, and on the other side we would have 1.933 minus 0.0031, which again is our lost motion. Okay, so we would have two bands here. We'd have one at 1.0964 and one at 1.0902. And these bands would encompass our lost motion on either side, high and low. Once either of these barriers get hit, which would be in this case, because we're going down, which would be the 1.0964, okay, we would then put on a trailing stop. Let's take a look at a different example, one using that sloppy forecasting area that was highlighted above. And one note before we get to that area, you may want to see this just so you get it, because this is really important, and this is really how it's done. If you don't get it on the first pass, you may want to go over this video a few times till you do get it. Okay. So remember that sloppy area where it was just way off? Our high came in like 3 days later. I mean, that's just bad forecasting. Okay. Well, okay. Upper and lower barriers here. So here's our diamond, okay, our projected price, and we add 0.0031 and we subtract 0.0031, and we get these yellow horizontal lines here. So what's going on is price is kind of going sideways. This is really, even though this is okay, rest of this is just sideways slop. But anyway, we're going down, and our price was due here. We were just a few pips off here, okay, on the euro US dollar, and then we start heading up. We start trending up, okay. So we could throw on, we know where our next point is. We could throw on our upper barrier and our lower barrier, okay. So our price target gets hit down here, and we start going up. Let's move on. Okay, we've blown up that area, taking a closer look at it. Here's our target that gets hit. We start moving up. Okay, our barrier gets hit on this date. Okay, and that's the 27th of January. Barrier gets hit, trailing stop entered at barrier point, on barrier point, and follows the price up. Okay, now question about this is, well, you know, what's the ideal trading stop? And the reason, trailing stop, the reason for that, that it's different on all instruments, is because no two instruments are alike. What we have to do is we have to go in and we have to check and see through past history what kind of trailing stop would work best in this market. Would it be 10 pips? Would it be 15? Okay, you're going to have to do that work on your own. But anyway, since we're going up, once this lower barrier gets hit right here, we throw in a trailing stop because it's now inside our price target zone, you see. All right, let's move on. Then the next bar price, the upper barrier gets hit. Okay. When this occurs, it's a great time to enter, or if you're still long, you would exit at that. Then the whole process starts over. Okay? Because once this is confirmed and we put down our next price and time diamond, which I don't know where it was, but it may be over in here, okay? And we would put on the barriers. And again, now see this next move, which would have been down probably a low point here, because look at this angle here, kind of comes down to here or here. I don't know exactly where it's at in this, but the next move is good. Okay. So what the deal is we use these price projections, we put on what we're calling price barriers so that we know where this active price zone is. Okay, and the size of the price zone varies by instrument. I've shown you all how to get this. Okay, then the whole process starts over. You would put your dot here and project your upper and lower bands. You'd put your dot here. You'd project your upper and lower bands, and so on and so forth. Okay, that is the GANNS Forex Swing Technique. If you have gained insight from my videos, subscribe so you can get the latest on my free market calls, forecasts, commentary, and teachings. Knowledge is priceless. Hey, this is BA reminding you, you can succeed. Bye-bye.